You're listening to the greatest multifamily investment advice show. My name is Adam Ras, and now I'm talking everything multifamily for an in-depth conversation, and I will be diving deep into raising capital, deals, and underwriting process. Welcome back to the greatest multifamily advice show. Today we have Zachary Streit, capital advisor with more than 20 years on real estate syndication and lending. Please help me to welcome our guest today. How are you, Zachary?
I'm doing well, Adam. Thank you so much for having me on.
Thanks so much for taking time today to speak to our audiences. So before we start on capital subject, I would like to start with Way Capital
Sure.
beginnings and how you guys started all of the business.
Sure. So appreciate that. So Way Capital is actually a newer company, and I joke that it's kind of a newer, older company in a way. My partner, Malcolm Davies, and we started Way Capital in April of last year, April 2022. So I think we'll forever be known as the geniuses that started a new business at the top of the market. But I joke about that. But what we are is we're a debt and equity capital advisory shop. So we focus on helping what we call entrepreneurial sponsors, commercial real estate owners and developers capitalize their projects. Multifamily is a big asset class for us. We do a lot of hospitality also. Those are our two main asset classes. But basically, our focus is helping arrange financing for deals that are typically between, let's say, $30 and $150 million, sometimes higher. We can help arrange debt or loans for deals. We can help arrange equity for deals. We can help arrange co-GP financing for deals. We're essentially an outsourced CFO service for our clients, basically helping them navigate the capital markets. And there's probably no time in the recent memory that it's been tougher to navigate those markets than now. So maybe we've become a little bit more valuable than before, but we've been in this business for a long time, combined 15 years on the advisory side, a combined 40 years in the commercial real estate side. We were formerly at a mid-sized firm out on the West Coast called George Smith Partners for many years. And my partner Malcolm was a developer for many years before that. I worked on the principal side of the business, debt and equity, so both as an equity investor and a lender for about 10 years myself before I started working as an advisor for the last 7 years. But we were really excited to launch Way last year, and we had one of our best years ever. We closed $1.5 billion in financings that we arranged for our clients on probably assets with a total capitalization or projects with a total capitalization of, let's say, about $2.5 billion. And about $1 billion of that was after we started Way Capital in April of last year. So we had a really good initial 9 months of operations. And we're really looking forward to 23. I think what makes Way unique and special is we're kind of a strategic firm. We're debt and equity capital advisors only, so we don't do any investment sales. We don't do any leasing or any property management. We're not principals ourselves, so we're not investing, our own funds into deals, although we do invest our personal capital sometimes. We essentially are market makers for our clients. We help them find the optimal capital stacks, the optimal debt sources and equity sources to kind of help get their deals done. We're also structured unlike most other firms that are out there. So we're not part of a big brand. We're wholly owned. Just myself and my partner Malcolm capitalized our firm. And so when a fee comes in, we don't have to pay kind of, 50 cents on the dollar to the house. We keep 100% of any fee that comes in, which is awesome. But we float a big overhead. Our biggest cost center and our most important component of our business is really our human capital. And so we have a staff now that's, I think, probably 14 in total. So call it 11 or 12 folks that work directly for myself and my partner that run execution on all of our deals. And that is critical because it means that sponsors, clients, developers who are working with us are going to get access to maybe 10 folks touching their deal, which doesn't really happen in middle market shops. It maybe happens, if you're doing a $1 billion deal with Eastdil, but doesn't usually happen on a $50 million loan. It means that we can answer questions from capital sources quickly to help build momentum in the markets, and that's more important than ever before. So we really bring kind of outsized infrastructure and resources to the deals that we do. And then I don't think anybody hustles like we do. Like I said, I've already been to 3 conferences this year, And I must have had, I don't know, 150 meetings across all those three between myself and my partner. And we're only, I don't know, 3 or 4 weeks into the year. So, and that's regular for us. We are on the road a ton. We're meeting with clients, we're touring properties, we're meeting with capital sources to make sure that we really have our finger on the pulse of the market, on what's going on, and how to best help our projects or our clients and their projects achieve like optimal capitalization in what's become a pretty difficult time. So I think that's kind of way capital in a nutshell. I mean, I guess historically, again, it's been a lot of multifamily and hospitality. A lot of it's been Denver and West, but we opened up an office in Nashville in the Southeast. That's a big growth initiative for us to do more deals there, because we don't think there are too many structured finance desks like ours that are out there. And we have a long history in the space. We've probably done $10 billion, if not more, as capital advisors, ignoring all the deals that we did when we were principals before that. So it's been a really successful run, and we're grateful for it, and excited to build on that, kind of having kind of our own flag and our own company. I wouldn't change that for anything.
Okay, so your sweet spot is more with sophisticated investors and active investor within, I think, $30 to $100 million deals. And in this spot, I would like to speak a little bit, and this is going to be really interesting subject to the audiences, is the type of equity and debt on this range of deals. It's not the institutional size, but not in the starting point too. So on the equity part, as a services of Way Capital, I think, as you mentioned before, as a pension funds, private equity fund, insurance company. If you can a little bit elaborate on this part of the equity part or the debt part, is perfect.
Sure, happy to talk about what we do on the equity side of the ledger. So I would say, generally speaking, there are two things that we do on the equity side of the ledger. Number one, a lot of our clients come to us and say, hey, can you help me raise joint venture equity for our projects? And number two, a lot of our clients need what's called co-GP financing for their projects. And I'll talk about both in detail. So the first one is kind of maybe more broadly understood. It's essentially, trying to help find joint venture equity partners for deals. So when we do that, we typically are looking for deals that are, again, at least $30 million in size, but probably $50 million in size, just so that the equity check is at least, call it $10 to $15 million, if not more. And the capital sources that we would go to for those deals are insurance companies, family offices, and private equity funds that are out there that are looking to invest joint venture equity, typically into multifamily development deals. Could be garden style deals, podium deals, build to rent deals, micro unit deals, co-living deals, what have you. We've done kind of everything under the sun, both on the equity and the debt side. Within joint venture equity, since 2018 or 2019, when legislation was passed, we've also arranged a fair amount of opportunity zone equity going into development deals from opportunity zone funds that are out there. So we've probably done, I don't know, 7 or 8 of them, maybe more. So that's another interesting source of joint venture equity. And today, I would say that's probably the most active equity capital out there, because a lot of the equity capital that isn't opportunity zone is on the sidelines right now because there's too much market uncertainty. Opportunity zone, though, has lower return thresholds, is long-term capital, and it also has a need to be deployed. And that need is that there are tax benefits that go along with it. And if it isn't deployed in a certain period of time, it could lose those tax benefits. So we actually have a number of those deals that are ongoing right now. So that's kind of the joint venture equity side of our business. On the co-GP side of our business, this is critical. So for kind of newer sponsorship groups that might not be super established or have really big balance sheets, we can help arrange co-GP financing. And this need arises if you're, call it, doing a 30 or 40 or $50 million construction loan. You would need a net worth that's, call it somewhere between 50% to 100% of that loan amount. So if you were doing a $50 million loan, you would need at least a $25 million net worth. The lenders would kill me for saying that. They'd tell you need $50 million. And you'd need, probably 10% of that loan to be liquid for the life of the loan. And that's really hard. especially if you're a newer or younger developer, but that could be tough for any developer that's sort of asset rich and cash poor and wants to invest their capital into deals. And so what we can do to help those guys do more deals is bring in what we call a co-GP or a co-general partner. And what those guys will do is they will come in and they will sign on your construction loan for you, and meet the sort of net worth and liquidity requirements that a lender needs. And that will allow developers to do more deals, scale their platform, or in the case of younger groups that are maybe breaking out of institutions and spinning off and kind of starting their own firms like we did, to get their initial deals done, under their new flag and new banner. And so what co-GPs will do is they'll essentially credit enhance the deal, they'll sign on the loan, sometimes they'll invest capital into the GP, et cetera. So those are the two main things that we do on the equity front. Last thing I'd mention is on the co-GP front. It's a mix of sort of institutions and family offices that will do that primarily. Maybe there are more family offices active in that space than there are institutions. The checks tend to be small, but the returns can be really large. When you're doing a co-GP deal, typically guys in the GP can make, are looking to make 4 or 5 times their money. And so it can be a pretty lucrative place to sit and play in, and that attracts folks to it.
So as a capital advisor on this sweet spot, are you guys dealing with more REITs? Because this is basically the starting point for some of the REIT or public offering in general. So is this like some service you guys do, or just more like a private equity side?
Yeah, good question. We don't really deal with REITs. So we don't do like investment banking type initial public offerings or secondary offerings or debt offerings. All of our work is really in private real estate. And we tend to work with a lot of private equity funds in a variety of capacities. We might bring those private equity funds into deals where they are the joint venture equity partner, or maybe they're buying the real estate or buying the real estate directly, or starting a real estate project by themselves. Other ways we work with them is we often get hired by them to run a process to source debt financing for them on their deals. This has happened many times, where we kind of have a pretty deep knowledge of the capital markets and who the different real estate players are. And you get hired by those players. Another reason, frankly, that we make a lot of equity introductions for our clients is because we want to get to know the equity players well. Because when an equity player shows up in a deal, and maybe they show up in a deal after you've been hired by the sponsor, and maybe the sponsor sourced them by themselves, it's really important as a capital advisor that you have a relationship with that equity partner. Because if you don't, that equity partner could be 90% of the equity in a deal. So they're 90% of your fee as a capital advisor. So they're essentially your boss, even if they didn't sign your engagement agreement. So he who has the gold makes the rules, right? So you want to make sure that those guys know you, that they like you, that they want to work with you. And of course, most importantly, that they think you can execute. So there's many reasons that we do kind of what we do, but I guess to answer your question, it's all sort of private real estate, private equity that we work in. It's not in the public space.
I think one of the questions here is when you're dealing with family offices and pension funds, you need some sort of leverage and experience. And with your role as a capital advisor, what is going to be your advice for, I'm going to say like 5-6 years active syndicator was trying to move to the next step on the move with the bigger deals? What's going to be your advice for those who are trying to have this relationship with family offices, especially that you're going to be the intermediate step between the active syndicator and the family office?
Sure. Call us. No, sure. I'm kidding. Well, that too. But I think my advice would be you need to be patient. Equity isn't like debt. It's not transactional, and it doesn't happen overnight. Building a relationship with someone who's going to write you a $5 or $10 or $20 million equity check takes time. And I would start trying to build those kind of institutional private equity relationships, whether they're insurance companies, family offices, or private equity funds, early. get to know as many of them as you can, reach out to them if you see them doing deals. We can help make introductions for folks that need them that we think kind of make sense. Start making those connections early. We just got back from a conference last week. It's the IMN conference. They have two of them. This one was their West Coast Private Equity Fund Conference. And a big way we use that conference is to just meet new equity partners that we don't know and stay in touch with the equity partners that we do know, so that when our clients have a need, we know who to call. And I would recommend that sponsors out there try and do as much networking with equity capital as early in the game as they can, so that you're not coming to them saying, hey, I got 30 days to close this deal. Can you write me a $15 million equity check? That almost never happens. You need to spend probably a couple years, realistically, building these relationships while you continue doing deals and building your syndication track record. So I would really do both in parallel. That is my best advice, is just start early.
I agree on this. That building the relationship early is the way with any of the. I'm gonna name them like smaller institutions, equity fund or source of capital. So regarding because we're working on the multifamily space and we're talking about usual fees for this kind of service. Like for example, on syndication, you have like some sort of like acquisition fees. For a capital advisor, what usually is the actual fees when you're part of the deal?
Sure. Well, the short answer is it depends. It depends on a lot of things. It depends on what we're being asked to do. It depends on the size of the deal, the complexity of it. Do we have a pre-existing relationship with this sponsor? Do we not? And so on and so forth. But I generally say on the debt side, it's anywhere from 1% and then probably scales down. And on the equity side, I don't know, there's a myth out there that capital advisors can make 3% on equity. And maybe you can if you're an RIA or you're a syndicator and you're passing the hat. I've never seen that type of deal got done. Usually it's some sort of blend, or maybe we'll make 1 to 1.5% or 1.25% across the stack or something like that. So it's pretty market, I would say, and market driven. And look, we're in the business to make money for sure, but we're not going to gouge our clients. The lifeblood of our business is really relationships and repeat business and guys that we can do deals with, for a long period of time. And so our fees kind of reflect that, but it really depends, like I said, on what we're being asked to do. I mean, we'll do deals for significantly less than 1% if they're very big and they're a little more garden variety. And then we've done deals where the fee load's been higher than that, where they've been extraordinarily difficult, and in some cases taken years to complete.
So my next question will be about the downturn and the recession, and because we're not yet on the bottom of the market. From your perspective on the private and debt side, how you see the actual implication on the debt side, especially with higher LTV right now. Lower LTV right now in all of the deals. How you see the implication and how you see the market in the next year or so?
Sure. So great question. Tough question. That's the timely question. I think backing up, we saw a real cooling off in the equity markets in the third quarter of last year. And I think they were faster to react than the lenders. And then in the fourth quarter of last year, we saw a real reaction in the debt markets. And I think it's fair to say that we're in a bit of a liquidity crunch right now, that there just isn't nearly the liquidity in today's capital markets that there was a year ago, not even close. It isn't full stop like it was in March and April of 2020, but it has significantly slowed down. So deals are still happening. They're harder to do. I joke that we're working 3 times as hard on a third of the pipeline, and that's okay. That's what we're here to do. We're the guys that are known that do hard deals, and we really don't give up, which is so fun and awesome. And you can see a different side of it. It's a good learning experience right now for the young guys also, who haven't seen this before because they've only seen an epic bull run, maybe the greatest in history over the last 12 years. But that doesn't answer your question. To answer your question, what does 23 look like? My own view, as we sit here at the end of January, I think there's probably 2 more rate hikes coming, probably 25 basis points each, and then I think it's done. And then I think, at least from a federal funds perspective, it flatlines for the rest of the year, and we might see tapering probably in the beginning of 24. You may continue to see a rally in longer term rates as they say, hey, we may be in a recession and a slowdown now, but we won't be in 5 or 10 years. I don't think the yield curve stays inverted forever. And I think we are close to the top of where short-term rates are. I'll give you an example. This is sort of a timely thing. It was interesting. We closed a $70 million loan. It was a bridge loan, taking out construction financing on a multifamily asset here in Los Angeles back in December. We priced a rate cap for that deal. It needed a rate cap because it was a floating rate execution. In and around Thanksgiving, we initially priced the rate cap, and the rate cap was 2 points. So 2 points on a $70 million loan is $1.4 million. Now that is extraordinarily expensive for a rate cap, and that was also multiples of what my fee is. So it made me think I was in the wrong business. Regardless, when we closed the loan, I would say before Christmas, in those, call it 3 to 4 weeks, the rate cap cost had gone down by half. So when we closed it, the rate cap was 1 point. That's still an extraordinary amount of money just for a rate cap. That's still $700,000. But that's a huge, huge tapering in the cost. For something to go down 50% in 4 weeks is crazy. So why did it go down? What was the reason? The reason was the market started pricing in its belief that we were close to the top of the short-term rate curve, and that rates would either stay flat or more than likely short-term rates would go down in the back half of this year and into next year. So it's an interesting thing to watch because rate caps have been a big topic of conversation on floating rate loans for construction deals, for bridge deals, et cetera. And so that's probably a good sign for the market overall. But with that, look, rates are much higher than they were a year ago. Guys that need to transact, it's tougher. Leverage is lower, rates are higher, equity is more scarce. There's a lot of guys talking about preferred equity and subordinate debt structures to rescue deals. There are a lot of guys that think things are going to, get short sold by lenders again. So assets might trade less than their debt amount, their loan amount, and we're actually seeing that in the office space a little bit. We're financing an office deal that looks like that. So I think there's going to be, issues in folks' legacies portfolios, but I also think there's going to be a lot of opportunity for people that have, dry powder, that have capital to do new deals, to acquire deals at a lower basis, to start construction projects this year where construction costs don't go up and might actually go down 3, 5, 10%. We're seeing that in some markets already. We're not seeing it in all markets yet, but I actually think it's a great time to start a construction project this year because you will benefit from reduced construction prices. And I think a lot of people are going to shelve projects because equity and debt are so expensive and scarce right now. And so you'll deliver into a market that doesn't have a lot of supply. It's harder to get it off the ground from a capital perspective, but if you can, I think you get rewarded. And look, historically, when you look beyond the past few years, which have been amazingly frothy, I think those are the people that have gotten rewarded. I think people who started projects, post.com, post GFC, and there was a lot of uncertainty out there, and maybe they got less leverage and they paid more for debt and they had to backfill with more equity. It was more expensive, but they delivered their development projects in 2013, 2014, 2015. They did really well because of that. And so I think 23 is going to look a lot that way.
Regarding the debt side, I see a lot of like a big shift to more the fixed rate, other than the trend on 20,
Sure.
especially on 22 was the floating rate or the interest only rate. So what is the reasoning of this in your opinion? That
Sure.
the market shift only to the fixed rate other than the floating rate and using the cap rate?
Sure. That's a great question. I think the big reason is just all the volatility in rates. I mean, we had 500 basis points in rate hikes that occurred in the back half of last year. That was unprecedented. And when people started seeing that or were going through it, they're like, having a floating rate loan is crazy because my interest rate can go up so high. And then the cost of rate caps got really expensive. Like I mentioned, I mean, 2 points for a cap, it used to be 20 basis points. Like it went up, like 1,000% or something, which is crazy. And so folks were like, forget it. I'll take fixed rate financing anywhere I can because it locks my rate, gives me certainty on what my debt service is going to be, and I don't have to pay the added cost of a rate cap. It was a little unfortunate is that fixed rate financing kind of dried up in the market in the last 6 months of last year. And it's kind of coming back a little bit. But when folks needed it most, it kind of wasn't there in a widespread fashion. And I think it's still nice now because rate caps are still expensive. But I also think that ironically, it's a little late now because I think we're close to the end of the rate hikes. Could be wrong. So it may be less necessary in reality. But from an optics standpoint, I think almost all sponsors want fixed rate financing on every type of deal, except maybe permanent financing because it's so expensive. But on bridge and construction financing, all day long, in a vacuum, all other things being equal, they would take fixed rate financing over floating rate financing just because of the recent past and what happened with rate hikes going up so much. And look, there were lenders that were getting, I think, a little bit aggressive, less conservative, let's say, and allowing guys to close loans without rate caps, but with springing obligations if rates hit a certain level to buy them. And those springing obligations ended up being very, very expensive, way more expensive than anybody thought. So fixed rate loan, you don't have to deal with any of that. So there's the big advantage in that respect.
I think the only downside of the fixed rate is going to be the actual, the lower LTV that you're going to need to raise more equity side.
Yeah. Well, that, and you could be stuck in a deal for 3 or 5 years and rates might drop on you, right? Yes. It's a bet like anything else. Both floating and fixed rate deals are bets, in my opinion. And if rates go back down to 3% and you're stuck in a 6 or a 7% fixed rate loan, or even a 5% fixed rate loan, you don't feel great about life. Whereas if you closed a 3% fixed rate loan, back in January of last year, now you feel great about life. So it's really just a bet on where you think things will go.
My last question will be, for me, I love King of Capital book about private equity fund and how Blackstone has been in rise and fall. In your opinion, what is a really book you like or change your mindset regarding capital and raising capital in general?
Ooh, that's a good question. What is a book that has changed my mindset regarding capital in general? I think, is it a book called The Real Estate Game? I think that's kind of like the Bible. It stated that everyone should read that game. It's been around for a long time, and especially for guys that are just kicking off their real estate careers, I'd recommend that. I mean, it's both kind of finance and real estate. So I think that's the one that probably impacted me most. Beyond that, I listen to a lot of books on Audible when I run, and I've learned a lot even from non-real estate books. Like 2 books that I love were Reed Hastings' book on Netflix and Bob Iger's book on Disney. So those are obviously outside of like real estate and capital, but those are books written by obviously super prominent CEOs that have very different views on how companies should be run and scaled, but both of them built and helped scale incredible companies. So maybe those are the 3 that I would recommend for different reasons.
Good stuff. Great information about the equity and debt part, especially with the recession and speculation of what's going to happen in 2023. My last part will be how people can reach you and follow your success.
Sure. Well, I appreciate that. You can reach me on LinkedIn. I've got a lot of followers, and I try to be as diligent with follow-up on messages, on DMs as possible. I tweet a lot, or at least I used to tweet more, and I'm going to start tweeting a lot. You can go to our website, waycapital.com, WAY capital.com. I think my cell phone number and my email address are up there. You can also email me, and it's zstreit@waycapital.com. So I'm pretty eminently reachable. Guys in my role tend to want to be. And look, we're always happy to have conversations and to help guys scale in kind of any ways that we can. So for folks that they're interested in kind of learning more, you know, if I can help you, not you, but any of your audience career-wise, then I'm here to be a resource.
It's a really great subject. I know it's for sure, and we have to bring you again to talk more about the private equity fund subject.
Yeah.
And I really appreciate your time today.
Yeah, thanks, Adam. Appreciate it also.